Welcome to Straight Talk Tuesday. Today is August 11th, 2020, and we're covering debt management as a part of our financial wellness series. I'm Brent Bowers, a retirement plan advisor at Retirement Plans Inc. And this presentation has been put together in conjunction with Rich Myers, a retirement plan advisor at Retirement Plans Inc. Let's look at today's agenda. Today we're going to cover debt, good versus bad debt, repayment strategies for any debt we may have, refinancing and negotiation of our debt, and appropriate debt levels to use when we're thinking about how to manage our debt load. So what do we mean when we say good debt? Good debt is something that's going to appreciate or has the opportunity to appreciate in value. Things such as a mortgage on our primary residence likely will appreciate in value. A business loan, which will allow us to create a profit based on a business service or product we're providing. School loan, which provides us education to pursue a career that will allow us to make money. Those are all things that we would deem or use the term good when it comes to debt. On the flip side, bad debt is something that would appreciate in value. Things such as a car loan, where when we purchase the vehicle and drive it off the lot, it's going to depreciate immediately in value. And over time, it'll depreciate in value. Or a store credit card where we're purchasing clothing. Those are all things that will appreciate in value in what we deem as bad debt if we're carrying debt to acquire those things. Next, let's talk about repayment strategies for debt obligations you may have. There are two methods we're going to cover. The first being the snowball method. We're going to organize our debt, listing our lowest balance first, and then our highest balance last. And what we focus on is that first lowest balance to make sure we can get that paid off as soon as possible while making minimum payments on all other debt obligations. And once we've paid off that first obligation, we roll that payment we're making into the next, and so on. This creates a snowball effect and creates positive momentum, and we get positive feelings as we see our number of debt obligations start to decrease. The second method is the highest interest first method. So in this method, we organize our debt, listing our highest interest rate first and our lowest interest rate last. We focus on paying off that highest interest rate debt first while making the minimum payments for all others. And once we've paid off our highest interest rate debt, we move on to the next highest, and so on. This minimizes our amount of interest that we pay over the lifetime of the debt obligation, thus being the most efficient for our money. This is likely what we would recommend as long as you're able to follow it, but either method is appropriate if you can follow it and stick to it. So let's talk about refinancing and negotiation of your debt. There are a number of things we can do to try to lower our debt obligations. When it comes to credit card debt, the first thing, which most may not realize, is we potentially can negotiate our interest rate. So just by calling your credit card company and requesting a lower interest rate, you might be surprised the number of people that have success in doing so. The next thing, which ties into our last topic on the financial wellness series, is to review our budget. Are we able to make cuts in certain areas to improve our surplus, thus increasing the ability for us to pay our debts down quicker? Next, we can look at refinancing and consolidating our debt. Interest rates are at near lows or at record lows at this time. And if we can consolidate all of our debt into a lower interest rate and do a single debt payment, it may be easier for us to manage. One of the best ways when looking at refinancing and consolidating is through home equity loans, if that's an option for you. If you have equity in your home, you can use that to gain a consolidation of your debt at typically a lower interest rate. This is obviously a backed loan since your house is backing that loan and will likely result in the lowest interest rate you're able to obtain versus just consolidating on a personal loan basis. Let's pause here for a quick financial fact. 37% of US households have a revolving credit card debt from month to month. What that means is about a third of US households are not paying off their credit card bills in full every month, carrying a balance into the next month, and thus incurring interest charges, which on credit cards are typically very high. So now let's take a look at debt levels as a rule of thumb. If we have paid off all of our debt or we've not yet acquired any debt, what is some of the benchmarks we should look at when thinking about how to manage our personal finances and how to utilize debt? As a rule of thumb, looking at debt levels, what we would advise is that no more than 25 to 30% of your gross income is used for your home. This would include your principal payment, any interest that you have on that payment, insurance, and taxes. On all debt as a whole, including your house, we would not want to exceed 35 to 40% of our gross income. And the reason for this is we want to allow for adequate ability to save for future expenditures, such as a car, so that we're not having to borrow to purchase a car, which we all know we just covered as a depreciating asset, or to be able to put enough money away for us to be able to retire successfully. So that's why we want to maintain these levels of debt utilization within our personal finance portfolio. If you have any questions about debt management or in general about any of the topics we've covered in our Straight Talk Tuesday series and financial wellness, please reach out to either Rich or myself, and we'd be happy to help you. I hope you have a great rest of your day, and I'll see you in a couple weeks on our next edition of our Straight Talk Tuesday.